Hello everyone, my name is Ivy Wamboi Morage. I'm in cohort 1 and I'll be doing a presentation of the project that I did, which was application of statistics in financial markets. And I'll start off by giving you an overview of what statistics is, and then I'm going to show how statistics is applied in the financial market. So, as you know, in our day to day life, statistics is used everywhere. It's used in business, it's used in education, in so many sectors of the economy. So, an example is, for example, when students do their examination, they get scores. So, those scores they're collected. After that, they're interpreted, and then are analyzed using statistics. So after that, they'll make informed decision based on the findings that they find after analyzing the data. So after that, they can conclude who did best or what was the average score of the class. So in layman's language, statistics is a piece of data from a portion of population. So it is used to understand the data that is collected about us in the world. So this is where the term statistical analysis comes in. So statistical analysis is a method that is used to draw conclusion from data objectively. It's like another way of saying statistics. So in statistical analysis, we perform things like collecting data, interpreting it, and also analyzing it. So in this project, I'll be looking at the application of statistical analysis in financial markets. So as an investor or an analyst, there's some things that you will need to understand. There's some factors that have to be put into consideration. So for you to obtain this or to achieve this, you have to work with tools, with technological tools. So one of them is the statistical analysis, which I'll be looking at in this project. So my research objective is to explain how statistical analysis is used in the financial market and how it's used and the importance of it in the financial market. And I'm also going to use a technology to demonstrate how the statistical analysis is done in a particular technology. So I'm going to do an introduction of financial markets. So I need you to get an understanding of what is this. Maybe you've heard it in the news or you've heard people talk about it, but you're not really sure what it is. So financial market is a market in which people invest their money in trading financial securities such as stocks and bonds. So stocks market, which was the financial asset that I looked at, is simply a place where owners of a company exchange their shares for cash with other people who want the share of the company that they own. So it is a market that enables creation and exchanges of financial assets. As I said, those assets, we have stocks, we have companies share, we have bonds, so such things. And for you as an analyst or an investor, there are things that you have to put into consideration before deciding, okay, I'm going to invest in stocks or I'm going to invest in bonds. So some of those factors that you have to put are returns on investment, which are the percentage change of the closing prices of 2 days. So another one is the risks, because we know that in every financial asset or investment, there always has to be risk. So those are the things that we look at: the liquidity, taxation, and among others. So among this, I'm going to look at returns on investment and also the risk and how statistical analysis is used to determine them. So first of all, we need to come into terms why is it important to the importance of statistics in the financial market. So as we know, we're in the age of information. where information has become paramount and it's used everywhere, and it's used in making informed decision. But for you to actually make informed decision, you really need to understand the data. And how will you understand the data? So by using these tools, an example, the statistical analysis tools, you can actually interpret the data, analyze it, and from the findings that you get after doing the analysis, you can come up with informed decision, which are very paramount. So at the end of the day, you know that these tools will help you arrive at a conclusion and also prove a hypothesis. So that is why they are very important in the business sector or in the financial sector, and also generally in the economy. So for you to work on statistics, you need to understand some of the terms. So for example, we have the mean, which is the measure of central tendency in a probability distribution. Along the median and the mode. So in the layman's language, the mean is the average collection of numbers. So for example, you have students or the marks of students, and you want to know the mean. You will take the scores of the students, you add all of them. This is what it means. This is the summation of all the scores, and then you divide by the number of students. So after that, you will get the average mean of the class, or the average score. So we also have the variance. The variance measures the average degree to which each number is different from the mean. So like the scores, how do they differ from the mean, the average score? So this is a formula, and this is actually the sample variance. This is how we get the sample variance. So we know that most of the time we'll work with the sample population. That's the sample from a population to prevent biasness, so yeah, and such things. So we also have the standard deviation, and standard deviation is calculated as the square root of variance by figuring out the variation between each data point relative to the mean. If the points are further from the mean, there are a higher deviation within the data. If they're closer to the mean, then there's a lower deviation. So the more spread out the group of numbers are, the higher the standard deviation, and the more they are closely together, the lower the standard deviation. So standard deviation is one of the key methods data analysts they use to determine the risk. When the returns are close to the average return on investment, the investment is less risky. And when the return is further from the average returns on investment, the investment has a greater risk to a potential purchaser. So this is the formula that we use to find the standard deviation. And the standard deviation, it's like the square root of the variance. For the variance, it's like it's the square. Let me say it like in a simpler way, it's like the square, while the standard deviation is like it's the square root of the variance. We have the kurtosis, which is a statistical measure used to describe the degree to which scores cluster in the tails or the peak of a frequency distribution. So this explains, it's the formula that's used to find the kurtosis. So I'm going to explain how I used Python to perform my statistical analysis. I started off by importing some of the libraries, as you can see in this code snippet. And then after that, I read my CSV file using pd.read underscore CSV, and then I displayed the first 10 rows of my data frame. So I also need to inspect my data frame because I need to know the data types. And as you can see, my date has no data type. It's an object. So I need to change that, because if I don't, it's going to bring a problem, especially when I'm plotting the histogram. So to convert that, I use the pd.to date time to convert my to change the data type of my date column in the data frame. So looking at this, you can actually see it was changed over here. And then after that, I'm going to plot my graph using the matplotlib, and as you can see, this is what I get. So this is actually like Matplotlib. It has very powerful plots that are used to give insights about stock. So this is what I get after doing the plots, and I use the close price column and also the date column to plot my graph. After that, I created a column so that I use it to find some interesting inferences about the stock. So I created a column that is called the daily lag column, which is basically I shifted the close price, this one, and 1 day. So as you can see, the first row, the in the last column there's no data, but they've been shifted 1 day before. So which I so this yeah I'm sorry. So yeah, so after that I have to find the daily returns, and to find the daily returns I took the daily column, daily lag column, and then I subtracted the close price column. So after I did that, this is what I get. These are the daily returns. So I also, after that, I plotted a histogram of my daily return, and then after that I found, I used dot mean method and dot std to find the mean and the standard deviation respectively. So after that, I found the kurtosis, and the kurtosis, as you can see here, I got it as 18.98 to 18.982, and it tells us the fatness of the tail. So it is basically important because it tells us how extreme the values can actually get. So yeah, the mean, and we said if the standard deviation is actually further away from the mean, then it means that the risk will be high compared to when the standard deviation is close to the mean. But you can see the average returns of the stock, it is not that bad. It's quite high. If we convert it into a percentage, it's going to be a high number. But we all know that as much as somebody has higher returns, also the risk will be high. So in conclusion, what I'm trying to say is understanding some factors that need to be considered when choosing what to invest in is important. So using statistical analysis, investors or analysts can use mean to find the average returns, which tell them what the returns for a stock or security have been in the past. And the standard deviation, on the other hand, it is used to measure security and market volatility, which in turn plays a large role in creating a profitable trading strategy. So at the end of the day, we will be able to make informed decision. Okay, what strategy will we use in order to make profit? So this is where these two, the mean and the average, they come into play, and also it shows the importance. So the exercise kurtosis is a valuable tool which is used in risk management. So they need to manage the risk after they calculate or measure the risk using the standard deviation. So they need to come up with a better risk management to manage all the risks that they come along. So this might be statistical analysis might not be the only tool which is investors or analysts need to use in order to make informed decision or to figure out other factors or to better understand them. However, it gives a clue for investors to take necessary decisions with the stocks that they are working with. So that is it for my presentation. Thank you.